Welcome to the Value Investor TV podcast, the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
Welcome, guys, for this episode. We're going to be talking about Kraft Heinz, pretty iconic brand in American history, American corporate history, American life. We'll talk about this brand today. So kick us off with this disclaimer, please, Hari.
Yeah, this is the Value Investor TV podcast. We are a podcast that helps educate you and entertain you about the concepts that underlie value investing. We are not financial advisors, nor do we know your specific financial situation. So if you're making any investment decisions, please consult with the appropriate advisor.
Great. Just a couple of things before we start. As you guys know, most of you guys know, when we analyze a company, we go through a checklist. And we have our own checklist. So if you guys are interested, please email us at info@valueinvestor.org, info@valueinvestor.org. And also, something that we announced in the last episode, and a lot of you guys are already part of this, but if you guys want to be part of our Slack community, Slack is it's an online chat platform where you can come on, talk to us directly, message us directly, message each other directly, ask questions to us, or propose a topic that we should discuss in the podcast. You can do all sorts of all of that in our Slack channel. So if you guys are interested in being part of this group, please email us at info@valueinvestor.org. Okay, Hari, let's get started with this checklist. Off the bat, the first question that we ask is this: what does the company do? You should be able to answer this question in less than 2 sentences.
Yeah, I think most people here could answer that question. So Kraft Heinz is a food manufacturer. They are one of the iconic brands that were merged in 2015. A merger between Kraft and Heinz food. So the maker of ketchup, like Heinz ketchup, and Kraft cheese and various other products merged together to make a giant food conglomerate. And amongst the brands that they own, I'll just read from this list: Kraft, Oscar Mayer, Heinz, Philadelphia, Lunchables, Velveeta, Planters, Maxwell House, Ore-Ida, Kool-Aid, and Jell-O are amongst the brands that they own. I was reading only from the U.S. list, but they actually have trademarks and brand names across the world as well. So in addition, Canada and the Europe and the rest of the world as well.
Yeah, I think that was a pretty straightforward question. A lot of us already know what Kraft Heinz does. It's a conglomerate that has all these brands as their portfolio of products and product lines. Okay, let's move on to kind of the meat of this section, which is the competitive advantage. Does the company have a competitive advantage? Describe them in the categories below. So should we just go down the list, or do you want to give us kind of a higher level view before we go down the list?
Well, so I think one thing I want to say before we get into the competitive advantage is kind of just the overall feel that I got from reading this annual report. And, generally when I read an annual report, I would say 99% of the time, you come away from reading it and feel a lot more comfortable about, like, oh, there's a lot of things I didn't know about this business, or there was something interesting that I just found out. And this annual report did not have any of that. And they barely talk about the actual business, and what's happening inside the business. What is their kind of, what they see as their competitive strengths versus others, where their competition is trying to, beat them, and how they're going to kind of one up on them, that kind of stuff. I was frankly very frustrated by reading this, annual report, because generally, I find that the annual report is where I start with. I look at it, I read up on it, I try and understand what the company is trying to propose as why they have a competitive advantage. And then I go and look at, the conference calls and quarterly reports and other things, and I just stopped after the annual report because this was just tiresome to read. Frankly, there was nothing there that I just kind of explained the business or made me understand how the food distribution works or anything like that. They didn't mention the competition from and where it comes from. So I got some details there, but I never felt comfortable with after reading this to say I would move on to an annual report, right? And so I would actually stop my analysis right here, right? I've read a little bit, and I think it's not all of you out there who are listening and are paying attention to companies, you don't have time to read 1,000 annual reports a year, right? So when you run into something like this, you kind of just want to stop and say, okay, I'll move on to the next thing, right? And that's where I felt like with this one is I put in my hour and a half reading this, taking notes, trying to get a handle on it, and I just didn't get anywhere with it. So there was almost most of the time when I find a good company, I get excited, I want to read up on it, I want to learn more about it, and I just didn't feel that. So
yeah.
So short answer here is competitive advantage. I'm going to do my best. I just didn't get a good feel from doing this. And that is unfortunate because I don't want this to be a wasted episode, because I do think there's some value for you guys to what we're going to talk about. But so we'll go through that here.
Yeah. Let's go through that. We'll go through this list, but I think this is important to highlight here. You mentioned that this is as all of us, most of us who are listening to the podcast are retail investors, and we don't do this professionally. We only have so much time at our hand to look at companies on our downtime, right? So if you run into a problem like this, where it's a well-known company, a lot of people understand what they do at least at a high level, and you dig deep into what they're trying to do through 10K and quarter reports and reports, which is kind of what you have, right? You don't have anything else but that most of the time to rely on to understand the business, and that's where you should be going. But if that source turns out to be very, very difficult to read into, like the one that you're experiencing now, Hari, I think it's worth mentioning that at that point it might just be that it's not your problem. It is the problem it's a problem with the report, Kraft Heinz report. So I think it's important to highlight that. So thank you for bringing that out, Hari. But let's move forward in discussing some of the competitive advantages here, Hari. So could you describe to us, is there any? Let's go down the list. Is there any brand competitive advantage here?
Yeah, I think that's definitely the case. Everyone has heard of Kraft macaroni and cheese and Velveeta and Oscar Mayer and Heinz ketchup and so on. These are all well-known brands. Many of them, 100 years old, and have been in. I grew up eating Kraft mac and cheese, and that kind of stuff it's very well known, right? So the brand there has a lot of mind share, as it were. But I think there is some level of it where that brand is not necessarily as strong as people would like it to be, right? I think when you look at the Kraft brand, I can go now to the grocery store and get lots of different types of macaroni and cheese. And, is it worth a price premium to buy Kraft mac and cheese? Well, probably not. I mean, the private store brand, Costco brand or Safeway or whatever store, grocery store you have near you, makes equivalent mac and cheese. So buying Kraft versus them, it doesn't necessarily carry a huge weight,
Yeah.
I think
we'll talk. Yeah.
Well, go ahead.
Go ahead, Hari.
Well, so I think there is, the brand is really the only moat that I would see here. Because when we go down this list, what we're going to find is it is the only thing that you will find with these food manufacturers, and business, tastes have changed in the way consumers think, right? So, I know I'm answering the next question on the checklist as well, but so I think just to sum it up, it's the brand is really the strength of their advantage right now.
Yeah, I mean, you mentioned kind of the downside of the brand, maybe some of the weak points of the brand competitive advantage, the fact that consumers have changing behaviors all the time, and there are all these competitors coming in with their own brand competitive advantage, right? Kraft is not the only player out there. They've got thousands of others.
Yep.
Which is probably true, but it is kind of in contrast to, this is something we didn't talk about, but Kraft Heinz is, I'd say, kind of famously known for the fact that they're one of the portfolio companies of Berkshire, right?
Yep.
And so the bread and butter Berkshire play is a kind of a brand sort of moat, where you have brand like Coca-Cola. I think Coca-Cola is a good example of how Warren Buffett or the team makes their decisions. Like Warren Buffett thinks Coca-Cola is this kind of prime example of how brand moat can really strengthen its business. And in that light, how do you see that versus something like Kraft Heinz, where you posit that there is a brand, but yet it is not strong?
Yeah, I think the best example, excuse me, of this is kind of like Campbell's soup, right? So for the longest time, Campbell's soup was considered, one of those unbreachable brand things. When you bought soup, you bought Campbell's soup. And in the last 10 or 15 years, it's kind of eroded as there have been more store brands. There have been more. There have been brands that have been associated with these companies that are, more on the organic or healthy line. So there other things have kind of infiltrated their space, and I think a lot of that has actually come out from. So like when you look at Coca-Cola, there isn't an alternative product, right? So Coke has Pepsi. People who like Coke generally don't like Pepsi, right? They're not interchangeable in your mind, right? Whereas when I think about macaroni and cheese, or I think about Velveeta, the cheese products, or Oscar Mayer, or Planters, or Maxwell House, Maxwell House, in the 80s, that was the only thing my mom had in her cupboard. And nowadays she has premium, roast coffee that, she gets from the grocery store, with beans that she grinds in her kitchen and stuff like that. So, the brand never really kind of, it kind of stayed in place, and people's tastes kind of changed. Coke was able to keep their market share by advertising well. There wasn't a really strong alternative. The store brands have not been, the same. And there isn't a big price difference between them and the store brands. And so most of the time, people will just opt for the Coke because it's a known commodity. And it's strange, right? I mean, I understand how different these things are, but the thing that Kraft and other food manufacturers did when they made packaged foods is, in order to increase their margins, they lowered the quality of the food, and they started replacing pieces of the food. They and then here to cut costs, here to cut costs there, and then eventually 10 years later, the first 5 years nobody could tell the difference, and then 10 years later the food just became worse, right? And so now it's a packaged food brand, but has no quality that was what was originally associated with the business.
Yeah,
and
I want to get to that issue, because I think that is at the heart of this moat breach,
right,
if you will, right? So when I think about this issue, if we could abstract some of the concepts here and make that into some of the, maybe digestible lessons, if you will. So a success story of brand moat, Coca-Cola, kind of a failure. Maybe failure is too strong of a word, but not as strong. Let's say Kraft Heinz, case number 2.
Yep.
So the reason why they diverged, even though they started off at a good place, both at a good place as a brand moat, one successfully was able to secure their position, the other did not, right? If we could abstract some of the lessons, you talked about a couple of things. Quality, right? You talked about quality just there.
Yep.
You talked about investing in the brand image, the second thing. And then I would say third thing, maybe it's just an intrinsically category dependent.
Sure.
Right? When you think about food, there's always this consciousness, there's always this health conscious that goes into your equation, whether or not you buy certain one brand or the other. But when you're going out and buying beverages, like, sugary, fizzy water, you don't really consider in consumers' mind health benefits, because that when you drink Coca-Cola, you're gonna, this is not a healthy drink. So
Right.
you come in with an expectation that okay, this is gonna be not good for my body, but I'm gonna drink it anyway because I like it. Whereas, this is more of a, this is a kind of a different play. Do you think that that's at play here?
Yeah, I think there's definitely a part of that. There is the products themselves are different. Like when you look at clothing versus shoes, right? Shoes have a moat. Like when we talked about Skechers, there aren't as many shoe brands as there are apparel, brands, and very few of them actually have a moat around them. The clothing versus shoes. Food and drink are kind of in different categories, right? You look at brands that have longer staying power. Alcohol drinks seem to have a longer staying power than, food. And I think it's because food has become a lot more commoditized, and you have smaller subgroups of the population that, used to be in the middle class and now have moved up in the world. I mean, I grew up in a solidly middle-class family. We had a lot of the brands that were listed, that I listed earlier. And then as we have, I've gotten more, wealthier and moved up in the socioeconomic spectrum, I've purchased less of that, right? And, America has a smaller middle class than they used to in the 80s. And then I think there's another component to this. So, tastes have changed, but I think but I still drink, Coke, right? That didn't change, right?
Yeah.
But there's something that's also interesting to me about this is a lot of these brands are kind of rolled up, right? They were standalone businesses that were bought by Kraft. They were brought under the Kraft label or the Heinz label. And then they what made them good in the first place was the quality, the value, the taste, all of the things that they slowly beat out of the company, right? And so the people who were originally running it and were, focused on coffee or focused on Lunchables or focused on, the dairy market had a, closer eye to the ground than when you're a conglomerate, right? And so as a conglomerate, what you're trying to do is say economies of scale. The more businesses I have under one brand, I can decrease the food distribution costs. I can have warehousing that makes me closer to all my suppliers and so on, right? But I think the biggest problem that you have with conglomerates is as they start acquiring these businesses, the individual businesses lose the driving force that made them good in the first place, right? The reason that you bought a good business is it was run by people who knew that business well, and they had no other obligations other than that business. Now they're brought up and they are, the investment that may be made to improve the quality is not just at the brand level, it's above the brand level. And that person may say, I don't want to put in more money. Sales are looking good. Let's try and find as many ways to cut costs and cut corners, right? And so they build up the following, and then the following kind of has this hangover effect for several years where they just, out of habit go and buy this. And then suddenly one day they wake up and like, wow, this food is really not that good. And they go to a friend's house and they say, oh, where's this macaroni and cheese is like so much better. Where is it from? And, it's this brand or that brand. And suddenly they're no longer a Kraft, shopper, right? And that's kind of how it happens. And I think we're in the late stages of that for Kraft.
Yeah. And I want to emphasize this point again. I think you brought up a really good point about, when these smaller brands focus on quality and that's how they start, and then they reach some point in their market share, it's noticed by the big whale and they basically gobble it up. And then once they're in the mothership, they no longer have that disciplined focus on quality, and they kind of lose out on that. And that has, obviously direct impact to the brand image and the brand recognition in the marketplace. Absolutely. But I want to point out this very interesting divergence between food and like Coke, because I think there is a inherently different type of consumer behavior that's at play, which is, for food, people are getting more conscious about what they consume. This kind of organic movement, people are buying more, healthy things, whereas, soda is, you go into it with that expectation. So that sort of, that sort of kind of relentless focus on quality isn't so much warranted in that space, because Coca-Cola all they had to do is just stick with their recipe, and they did exactly that, and they're now wildly successful. And so I just want to highlight that there's a big difference between food and this soda category.
Yeah, and
would you agree with that?
Yeah, and I think it's not necessarily that food, like we can also look at like McDonald's, for example, right? McDonald's has been making the same kind of food, and they have a clear, distinct advantage above Burger King or Wendy's or, Jack in the Box, or name some other fast food place, right? That you can find it anywhere. They make very similar food wherever you are. Across the country, a Big Mac tastes like a Big Mac, that kind of thing. They've protected that brand very closely, right? And I think Kraft at one time had a very solid brand, and I think it's just slowly kind of leaked away, right? And I don't know that it's necessarily gone, but I do know that it's not as... I just looked in my fridge right before we started this, and none of the brands that were on this list are listed in my fridge. Mm-hmm. And, if I go to the store and I find ham, I don't really care if it's Oscar Mayer or, some other brand or, whatever. I'm not paying attention to that anymore. And if I go and get macaroni and cheese, the mac and cheese that we have for our kids is not Kraft, right? So, it's... a lot of these things, these companies actually started these brands and made that, the iconic food item. When you think Kraft, you think mac and cheese, you think, the cheese singles and stuff like that. I don't have any of those anymore, but they were, the prepackaged cheese that you would get in the store was, based on Kraft. Kraft kind of pioneered that and made that their thing. And a lot of that is gone now. So,
yeah.
So I think they had the opportunity once they got into the lead position, and I think this is largely something where they didn't continue that position.
Sure. So, yeah, I think those points are really clear. Quality, not maintaining the quality, which translates into kind of eroding brand competitive advantage. You have the kind of the M&A effect here. That ties into quality, and then there might be interesting lessons to be learned here in terms of kind of consumer behavior when we approach food versus sodas. So all these things kind of are very interesting elements at play here when we are talking about Kraft Heinz. So let's just go down the list. I know you mentioned up front that brand is kind of the only thing that you see here, but let's just go down the list just to do our due diligence. Network effects.
No, there's no benefit for somebody else having Kraft that I would, or Kraft Heinz that I would have it. So,
sure. Switching costs.
No, it's clearly very cheap to switch from one brand to another.
Yep. Low cost provider.
Like we've seen in the last few weeks that we've had discussions. I'm sure there is some benefit to their distribution and warehousing and that kind of stuff. But again, I'm not going to chalk up their that to them. I don't see that being a strong moat for them.
Yeah. And then lastly, intangible assets.
So I think they do have some of these, in that, they actually mention some of the patents that they have, and, their 75% of their balance sheet is actually goodwill. So, they are buying assets that are, have some intangible quality to them. In fact, the reason that they had a huge loss in 2018 was because they had to write down a lot of the goodwill on their books. So, again, I'm not, it's hard for me to just blanket say that that's the reason that they're successful, right? It's the brand, I think is their moat. And, I don't know that it's necessarily the strongest. So,
sure. Okay. All right. Let's go down to the next question. We kind of answered this one, but let's just get it out. How durable is the competitive advantage? What are the risks to the current competitive advantage? Ari?
Yeah, I think we already kind of covered a lot of this. So I do think there's a big risk, in that what you built up over time has changed. The country has changed. The overall, business that you created has kind of lost favor with society. I'm not sure that there is a. Like you look at their revenue, and I've talked mostly about Kraft, but 26% of their revenue comes from condiments, and if you go to any fast food restaurant, it's a Heinz ketchup. That's the kind of ketchup you see at barbecues and picnics and stuff like that you go to at, at schools and churches and stuff like that. So yeah, they have a lot of entrenched contracts. So maybe there is some, switching cost for, if you have a large business like McDonald's or something like that you would sign longer term contracts. But again, I think all of this is under, at risk, right? As we move forward with, they really have to keep up, right? I think is the big story here.
Yeah. Just just digging up some numbers here, just for the context, some color on Kraft Heinz. Their market cap is about $40 billion, doing sales of $26 billion. Right, Hari? About $26 billion in 2018.
Yeah, 26, and it's been flat for 3 years now.
Yeah. So that's kind of the ballpark we're looking at here. So a market cap of $40 billion, and then total revenue of $26 billion. We'll talk more about the details in the next episode, and a little bit here and a little bit in this episode. Okay, let's move on. What is the company's long-term prospects and runway for growth?
So I don't see that. They haven't grown in 3 years. So revenue is kind of has been flat for several years now, and I find it hard to imagine that there's going to be a long runway for growth here. I think there's actually a risk that it may reverse and go backwards. So I can't say that there's anything that in here that makes me think, that it's protected, right? I don't see anything here to make that claim.
Yeah, this is really interesting. Do you think that it's when companies have year to year for several years flat revenue, there's something bigger at play, which might be that the company's going through a kind of pivotal moment in their life cycle of corporation?
Yeah, I think, one thing that's going to happen to them is, as with a lot of businesses, during a recession, things kind of change, right? And people would say, well, Kraft is kind of a staples business. When, when the times get tough, people kind of revert to the cheaper foods, that kind of stuff. I don't know what's going to happen to them, right? I don't have a whole lot of insight into this business. I think that it's very hard for me to say that there is a good runway for this company, that they have a moat they'll fall back on. And frankly, the things that the brands that they have, I remember I was looking at this list while you were talking, and I remember advertisements for almost all of them as a kid, and I can't remember any of them now.
Mm-hmm.
Like I remember all the Kraft mac and cheese. It's the cheesiest, and all of these things that they used to do, and all of that's gone. Right? My kids don't hear all of that stuff. I don't remember any ketchup ads from Heinz. I'm really struggling to remember actually a lot of these. So. Yeah. I think what's happening is over time, the mind share kind of just slowly leaks, right? And, people who are older and, older generations remember it, and they just kind of, their shopping habits don't change. And then, like my parents, that's kind of how they shop. And then as newer, generations get to adulthood and so forth, they just don't adopt this going forward. And so...
Yeah. It seems like, it's as we talked about, kind of long-term prospects, runway for growth seems pretty minimal. But I want to bring this point up because I think a lot of corporations point to this and say, okay, this is going to be the next source of growth. And, a lot of times that's, it's kind of an easy way to sell yourself as a growth company, even though they might have reached a peak. And that is China and the emerging market. What is your assessment of that here? Yeah,
so their rest of the world only grew at about 5%, while the other business lines kind of shrunk. So I don't know that they have any special insight into China, and I don't know enough about the Chinese consumer to know what they're really buying. I just don't see what they've already penetrated is kind of what it is, right? And so if they're growing there, then they're offsetting losses here in the U.S. and Canada, right? And I think one thing that may help kind of elucidate where their market is 22% of their sales actually in the U.S. come from Walmart, and so that kind of tells you that almost a quarter of their sales are coming from the typical Walmart consumer is going to be buying. The prepackaged foods, that kind of stuff that Kraft and Heinz would sell, which makes sense, right? I think, we're not talking about high-end food that, wealthier people would buy, right? These are foods that are kind of staples, but even in that segment, there's a lot more options that are available to people now. And, the thing that frustrated me about this annual report is they didn't even mention that kind of stuff. Like the competition section, they said e-commerce is a problem, large format discounting is a problem, and private labels. But they didn't really go into any specifics. And they didn't really mention who is eating their lunch or why is it, where is it being replaced, that kind of stuff. Yeah. I just didn't see that. And so as much as I liked... or as much as I understand this, everybody here eats food, right? It was hard for me to see, foreign markets being a, savior for this company when they can't protect their domestic turf, right?
Sure. Yeah, that's an interesting take. It's certainly a valid one, I think. Okay, let's move on to the next question. Does the company require a lot of capital reinvestment to maintain its business? Can it grow without any further investment?
So I don't think it's going to grow, right? I think that ship has kind of sailed, and it's going to be hard for them. I don't know that capital expenditure was all that much. I'm trying to look it up right now. It was less than $1 billion that they spent on CapEx on average for the last 3 years. It was hovering around $1 billion. For a company that makes about had about 3 to 4 billion in 2.5 billion from net cash flow from operations. So they're spending about $1 billion on CapEx. So, I'm just not there's not a whole lot here that excites me about, about their growth prospects and being able to grow without really having to put a lot of money into the business to change, how things work. So,
yeah. Okay. Last question. Does the company have favorable relationship with the following? I guess let's ask the other question, which is, does the company have non-favorable relationships with the following? Is there any red flags that you see here, either with customers, suppliers, employees, regulators, community? I think this question is kind of inconsequential, given that the main piece of this segment is really talking about competitive advantage, but we should go through this anyway.
Yeah, I mean, I think we'd already mentioned 22% of their sales in the U.S. come from Walmart. 5 of their largest accounts cover 49% of their sales in the U.S. And 71% in Canada. But it's much lower in Europe at only 26%. So, I think that's the biggest risk to them is honestly the... they are somewhat dependent on, since they don't have their own stores, they are dependent on pleasing their retailer like Walmart or Costco or so on. And, Walmart is going to do what's best for Walmart, not what's best for Kraft, right? And I think Walmart sees that as, well, I can offer very similar product with the private label, Sam's Choice, or I forget the name of the Walmart store brand, that they can put right next to Kraft. So, they may have favorable relationships, but I would say that I don't see any unfavorable relationships, but I also don't see that relationship even matters to Walmart, right? In some ways.
Yeah, I mean, from Walmart perspective or any retailer perspective, right?
Yeah.
They're trying to just squeeze. Walmart is kind of notorious for this, right?
Yeah.
They have all the scale in the world. They're forcing suppliers to, if you want to work with Walmart, basically, your margins are going to be, very, very slim, because they're going to force you to provide to them the cheapest option possible, and then they're going to, add on a little markup, and then that's what they keep. But from their perspective, it is to acquire source products at lowest cost possible.
Yeah.
So yeah. Okay, so no red flags. Some red flags here in terms of the customer, but nothing that you can see in terms of regulators, employees, suppliers.
No, not really. I mean, they have so many employees, 38,000, and they're all over the world. I don't know that a union or a strike would really affect them too much. So I'm not too concerned.
Okay. Yeah. Okay, sounds good. Any more comments before we close out this episode, Hari? I think we talked about quite a bit about, the competitive advantage, the brand, or the lack thereof. We talked about kind of why that might be. We covered kind of the quality aspect of this, the M&A, and the lack of marketing that we've been seeing from them. Anything else you want to add here before we close out this episode, Hari?
No, I think we'll kind of close up here and then kind of talk about some of the valuation aspects and things like that, management, in the next episode.
Great. All right. Thank you guys for joining us. Again, we're going down a checklist, so if you guys don't have access to the checklist, please email us at info@valueinvestor.org. And if you want to join our Slack channel, please send us an email at info@valueinvestor.org as well. Again, Slack channel is a place where all of our listeners can gather and message us directly, talk to each other directly, and post interesting articles and make suggestions on what we should cover in the next podcast. So please do send us an email. All right, guys. Thank you so much for tuning in. We'll see you in the next episode.
Thanks.